Okay, what's up, guys? Good evening, everyone. Happy new month. Today is 1st of February, right? And today happens to be my birthday month. Okay, so let's quickly flash back on what we have learned so far, and then we'll now forecast for the new week, all right? So, firstly, you all already know how I trade, okay? You all already know how I trade. It's very simple market structure, POI and liquidity. I keep it as simple as I can. I don't complicate things, all right? So when I talk about market structure, we have market structure for those joining us for the first time. When I talk about market structure is simply the movement of the market, all right? So when we talk about market structure, we say that we have two types of market structure, all right? Two major types of market structure. That's what I normally use, which we have the uptrend and we have the downtrend, okay? And when we talk about the uptrend, it's simply when market is on a bullish scenario, when market is moving to the upside, all right? From the uptrend, you will know that it is when market is moving to the upside. And we have the downtrend, which is when market is moving to the downside, all right? Right? So in other words, it's called the uptrend is being called bullish market and the downtrend is being called bearish market. So what does that look like? When we talk about the uptrend, we have a series of higher highs. So let me use this as the up. Okay. So whenever you hear the uptrend, we have what we call higher highs, which and we have what we call lower highs. All right. So in a higher high, we have markets printing a series of highs and a series of lows that are higher than the previous lows. Okay. So it looks something like this. We have high here. So this high here is a high for now, and we have low here. All right. So why is this called a low? It's called a low because it is lower than this high that is just printed. All right. And then we have another high. Now, this high here is what we call a higher high. Okay, and why is it called a higher high? It's called a higher high because it is higher than the previous high. All right, and now we have another low. So now this low here is what we call a higher low. All right, and why is it called a higher low? It's because it's higher than the previous low. Are you guys following? So as simple as that. So for the fact that market is on a bullish trend, you keep getting a higher highs and higher lows, higher highs and higher lows, all right, until market switches trend to start printing otherwise. Okay. So this is it on what we talk about the bullish market scenario. Okay, now on the bearish market scenario, which is a downtrend, all right, so here bearish, which is a downtrend, we have what we call the lower low and the lower highs. All right, so the lower lows are when price is dipping. The lower low, a lower low is when price is lower than the previous low, and the lower high is when price is previous than the. Okay, sorry guys. Now it's here is it. So here we have a low here, all right, and then we have a high here. Why is this place called a high? Is because it's higher than this particular low here, all right. Now we have a lower low, okay. Now this lower low here is called a lower low because it is lower than the previous low, all right. Now we have a lower high. Now another low here, but this particular low here is called a lower high, all right. And why is it called a lower high? Is because it is lower than the previous low. So for the fact that market is on a bearish market scenario, we keep getting lower lows, lower highs, lower lows, lower highs, lower lows until price reaches trend and start printing otherwise. All right. So now that we have understand the way the market moves. Now let's quickly make more sense. Okay, so on the bullish market scenario, once we have our higher high, okay, once we have established our higher high, which will be at this point here, all right, our higher high, which will be at this point, okay. So our previous low, why is this called a higher high? Because it is higher than the previous high, all right. So once we get a higher high and price and the high is previous than the previous high. Now we call this place a break of structure. All right, we call here a break of structure because price break through the previous high. Are you guys following? So because price breaks through the previous high, now we have our new higher high, and then we have our new we have a low here. All right, the low that led to that higher high. Are you guys following? Now, in simple terms, if I want to keep it simple, what I normally use is swing point A and swing point B. All right. So now, where is my swing point A? The low that led to that higher high is my swing point A. All right. For a bullish market scenario, okay, I'm talking about bullish, and my swing point B will be the higher high, the recent higher high. So now, what does this mean, or what is this telling me? This is telling me that for the fact that price is inside my swing point A and my swing point B, that I'm bullish. All right. So for the fact that price is inside my swing point A and my swing point B, I'm still bullish. Now, what will I be looking for? I'll be looking for price. I will be looking for a way to buy so that I will follow price up to create the new high. All right. To create the new higher high. Okay. So now, where do I now buy from? We are now joining the P6. Where do I now buy from? That's where my Fibonacci tool comes in. Okay. I want to be buying from the discount level because buying from the discounts give me a higher probability on the trade. Okay. So I want to be buying from the discount level and I want to be selling from the premium level. Now, how do we know the discount and the premium level? The discount level, we will use our Fibonacci tool to identify the equilibrium of the price range. Okay. Once we have identified the equilibrium of the price range, below the 50% is our discount and above the 50% is our premium. All right. All right. So below the 50% is our demand level and above the 50% is our supply level. Now we will use our Fibonacci tool. Okay. Now, how do we plot our Fibonacci tool? We mark our Fibonacci tool from our swing point A, which is the low for the bullish trend, all right, to our swing point B, which is the high. Okay, you all can see the 50% at this level, all right, the 50% Fibonacci at this level. Okay, now that we have identified this 50% Fibonacci, 50% of this price range, which is here, all right, which is where we just highlighted. Okay, what we will now do? We typically wait for price to sell down below the 50%, and then we now start looking for a buy opportunity to create a new high. All right, so it's as simple as that. Okay, it's as simple as that. Now, for the bearish market scenario, it's just the opposite, but let me still explain it, okay, for the newbies here. Now, the bearish market scenario, bearish, all right, let me use that as bearish. Once we have identified our low here, and then our lower high, which is our high here for now, and then our lower low here, and price start switching back, okay. Now, once we have gotten this, what we will now do next? What we will do next is, since price has already given us a new lower low here, all right, and then there now becomes a new our lower high, okay, our lower high, which is our swing point A. Why? What, why do we call this a lower low? Because it is lower than the previous low. And the moment price breaks this our previous low here, we have what we call a break of structure. Are you guys getting me? We have what we call a break of structure. All right. So now what we will do, we start looking to sell. Like I said previously, that we want to be selling from a premium level and we want to be buying from a discount level. Now we have gotten our swing point A. Remember, for a bullish market scenario, our swing point A is the low, all right, and our swing point B is the high. But for a bearish market scenario, our swing point A is the high, okay, and our swing point B is the low. Now, marking this out, we already know that everything between this our swing point A to our swing point B, that price is still very much bearish. All right. So what will we now do? We'll use our Fibonacci tool to identify our premium and discount level. Okay. So identifying our premium and discount level with our Fibonacci tool, marking from our swing point A, which is the high for a bearish market scenario, down to our swing point B, which is the low. All right. Now that we have identified our Fibonacci, our equilibrium, which is the 50% Fibonacci level, the next thing we do is wait for price. Okay, here is the 50% Fibonacci level. Now, the next thing we will do is wait for price to come into our premium level, because now remember, above the 50% is our premium and below the 50% is our discount. All right. So the next thing we will do now is to wait for price. All right, wait for price to come inside our premium, and then we will sell down to our discount, targeting the lower low in order to create a new lower low. Are you guys following? So it is as simple as this. All right, it's as simple as this. So now let's go to forecasting. I don't want this video to be long, so I will skip so many things. So let's just go to forecasting. Let's forecast the new week. All right, so on our Euro USD, although I already made my forecast, but I'll use a clean chart. See the last week forecast here. Okay, let me wipe everything on my screen. Now, to forecast this trade with what we just learned, what I will do is, firstly, I will run a top-down analysis. Okay, and for me to run the top-down analysis, I will first of all go to my daily time frame. I normally go to weekly sometimes, but it's just once in a while, since one particular candle there forms in 1 week. All right, so just once in a while. But what I will do right now is I will go to my daily time frame. Okay, skipping the weekly, to see what price is doing on the daily time frame. And with what we have already learned, what we just covered now, you will see that market is clearly bullish. All right, why do I say so? From here you see that we have our high here, then our lower high, our higher high here, our lower high here, our higher high here, our lower high here, and our higher high here. Okay, so now let me bring it on a plain surface for you to see. Are you guys seeing? So now we have our break of structure one here. Okay, you see the way price came in. You see the way price came in, then break another structure. You see the way price came in and then break another structure. So basically, this is what we are looking out for. Okay, this is what we are looking out for. So our expectation now is, since we have this new high here, our expectation now is price to still come back here and then boom, break another structure. As simple as that, right? Now what will we do? So let's go back to the chart and see what. So our last break of structure is at this level here. Okay, so if this is our last break of structure, all right, because we have our break of structure here, we have our break of structure here, and then price pulls back. We have our break of structure here, then price pulls back and then lead to a new break of structure. So where is our swing point A and our swing point B? So here on the daily time frame, right, this is our swing point A because we are on the bullish market scenario. Our swing point A is at the bottom, okay, and here is our swing point B. It's as simple as that. I don't complicate it, I make it look very simple. All right, and here is my swing point B. So getting my swing point A and my swing point B, highlighting the both of them, okay, I already know that, all right, everything in here, for the fact that price is between my swing point A and my swing point B, that we are clearly bullish. Are you guys following? So now, what do I do next, or where will I start looking to buy from? Because obviously, the only thing I'm interested in right now is to buy. Okay, I have gotten my directional bias, which is buying this particular market. But do I just start buying because I've gotten my directional bias? No, that is not the case. What I will do right now is to use my Fibonacci tool to mark from my to identify my 50%, to identify my equilibrium, and then mark out my discount level and my premium level. So what I will do now is, using the Fibonacci tool, from the swing point A here up to the swing point B here. All right, now you can see that here is the 50% level. Okay, And I say that everything below 50% level, everything below 50% level is discount, and everything above it is premium. All right. So, and I want to be buying from the discount. So, obviously, what I will do is wait for price to come into the discount level to buy from. And price coming into the discount level, where will I now be buying from? Okay. Um, Firstly, I will highlight. Should I highlight it? Okay. What I will do now is I will go down to my 4 hour time frame to mark out my demand levels. All right, based on to read the internal structure of this particular, because we have already getting the external structure. Now let's go and read the internal structure to see what happened and know the zone that we will probably be buying from. Okay, so let's go to our 4 hour time frame from here. But before then, I will wipe everything here out, leaving only the break of structure here. Are you guys following at all? Hope I'm not confusing anybody. Hope I'm not confusing anybody. So here we have the break of structure, and here we have the swing point A, all right, and the swing point B here. Okay, so the next thing we will do now is to go to our 4 hour time frame, because we are getting our directional bias. All right. So our directional bias is bullish. Okay. Now let's go move down to our 4 hour time frame. Now on our 4 hour time frame, do we just start marking things out? No. What we will do right now is to analyze the internal structure. What happened internally? What did price do before breaking structure? All right, that's what we call internal structure. Remember, from the hour time frame, we are very, very much bullish. All right, but on the 4 hour time frame, we are seeing something else. So let's analyze it and see what we are seeing on the 4 hour time frame. So now, after the last break of structure at this level, you can see the way price start printing a series of lower low, lower high, lower low, lower high, lower low, all right? And then lower low, higher low, higher high. So from here we started switching, okay? From here we started shifting. All right, so this is the place we get our first shifts, where price fails to get our first shift here, where price fails to create a new lower low and then happens to create a new higher low. All right, are you guys following? Are you guys following? So price fails to create a new lower low and then create a new higher low. So that's our first shift. And then where we have our change of character is at this particular level here. Okay, at this particular level here, that's where we get our change of character. All right. Why did I say it's at this particular level, even though we have our shift here? Now you see, this was our last break of structure to the downside on 4 hour time frame. This was our last break of structure to the downside, all right? And then after that, we now have the break at the upside. So once price break here, we have our swing point A, okay? We have our swing point A here, all right? Because price has switched back, and we have our swing point B here, okay? So let's see what price do. Price came in, all right, price drop, and then boom, breaking a new structure. Remember, what we are reading right now is internal structures, all right? So price drop probably to a discount level if we should use our Fibonacci tool from our swing point A up to our swing point B, all right? You see, probably to the discount level, all right, and then break and led to a new break of structure. So our internal structure break was at this level. Okay, our internal structure break was at this level. So because these are internally, let me, so that the lines won't confuse. Okay, so if our internal structure break is at this level, and then this particular push out now led to the major break of the higher time frame. Okay, what we will now do, remember internally this is our swing point. Okay, we have here swing point A here, and then we have our swing point B, where the higher time frame swing point B is. Okay, but does that mean that price must respect this particular swing point, before and then started buying? No, price can still take out price can still take out this swing point and then continue buying, because the higher time frame swing point is at this level. Okay, but before then, we are trying to get a POI right now. All right, we have getting our directional bias. So what we are trying to get right now is a POI. Now let's study what happened. Yeah, what the next thing that we are going to study right now is mitigations. All right, places that price has already been mitigated and places that price that has not mitigated yet. Okay, so let's start. Now we zoom out the chart, okay, to start reading what price does. Now, as you can see, this particular level here, okay, has been mitigated. This demand here has been mitigated, right? Now, did price mitigate this particular demand? Let's zoom it to the left to see if price mitigate this particular demand. You see, price has not yet mitigate this particular demand here. So this kind of a potential demand that price might come to by after taking out this swing point in swing low. Okay, but that does not mean we will just have it in mind that there is a demand level here. Now let's still zoom out and keep reading what price does. Now, where is our next demand? We have a new demand here at this level. The price mitigate, okay, this level here. Here is the demand. All right. The price mitigate the demand. Yes, price came to mitigate this demand. All right. So if in this case, if price has already mitigated this demand, and then we have this particular demand here that price has not mitigated yet, which aligns with the higher time frame swing low. Okay. Now what do we do? Let's analyze the recent break. That's the internal structure recent break to see unmitigated levels. Okay. Remember, we have this demand here. Price has not mitigated yet. All right. This demand has been mitigated. Some people will say that, is this not the demand? How is that place being mitigated? Okay, you can mark this out as unmitigated level. Okay, mark this out as unmitigated level, then mark this out as unmitigated demand. All right, but which of the demand are we now going to be buying from? Now, after marking all these things, you see that we now have so many demands. All right, and probably price is going to react in in each and every of these demands. Okay, and in order not to buy early when price start reacting on this demand, what we will do now is to filter the demands. All right, that's what we call filtering. Okay, somebody say filtering on the chart. All right, let's continue. All right, so to filter this demand, what we will do is to go to higher time frame. Okay, since you are in the 4 hours, the higher time frame that we'll probably go to now is daily time frame to see the demands on this particular demands, to see which of the demand is the real demand. All right, and then the demand that is the real demand is the demand that we'll be interested in. So now we will go back to our daily time frame after getting our demands from the 4 hour time frame. So from the daily time frame, you guys have already seen that this particular first demand is a fake demand. All right, so probably is a try. Now we get rid of it. So this is how we filter our demand. Now, this second demand starts from here, okay? And if you look closely, you see that it has already been mitigated by the week of this particular candle. All right. So by the week of this particular candle, this particular demand here has been mitigated, okay? But we still have another block at that level there. Okay, so that other block is now this particular candle. All right, but will not be more, and now that other block is now this particular candle. All right, this particular demand here has not been mitigated at all. Now let's go back to this particular demand here. Okay, that demand, that our unmitigated demand. If you zoom out, you see that this our demand here has been mitigated as well. Okay, this demand there has been mitigated as well. So now, which level are we now interested in? Me, I'm probably interested on this particular demand right here. Okay, we still filter it more when we now go down to our um when we go down to our 4 hour time frame. Okay, now we are getting the bigger picture of the demands levels. All right, now to filter it more, we will now apply the liquidity concept. Okay, which demand has liquidity close to it? uh, mm, and any demand that has liquidity is now the demand that we are interested in. Okay, so we now have two demands out of four demands. We now have two, so we have filtered two out. So this particular demand here has been mitigated. So I'm really not much interested in it any again, but I'll keep an eye on it. Okay, so let's go back to our 4 hour time frame to analyze to apply the liquidity concept. Okay, so this demand now, this demand here, this whole level here, this whole zone here is a demand level. But does it have a liquidity? No. And if we should use this as our liquidity, if we should use this as our liquidity, you notice that the liquidity is very far from the demand level. All right, and price love uh price do respect demands that the liquidity are very very close. So once it takes out the liquidity, it mitigates the demand and then start switching to the opposite direction. So this demand doesn't have any liquidity. So for me now, this particular zone here is a trap, but though I will keep an eye on it. All right, because we don't tell market what it will do, we react to what market does, but we analyze in order to have a higher probability chance to win the game. Okay, so this particular demand for me is a trap. So what I will do is I will name it SMC trap. Okay, but before I even name it SMC trap, to filter it more, I will now use my Fibonacci tool, all right, to map from my swing point A to my swing point B of the higher time frame. Okay, now marking from my swing point A to my swing point B of the higher time frame, okay, you see that this particular demand is on my 70% Fibonacci level. Then this particular demand that I want to call a trap is on my 50%, is on my 60, is between 60 to 50, 50 to 62% Fibonacci level. All right. So what I will do here, basically, what I will do here is call this first demand a smart money trap. Why I will call it a smart money trap now is not a smart money trap yet, but why I'm calling it a smart money trap now is so that I won't I won't move aggressive when price come to this demand. All right, I will be very very patient by telling myself this demand, this zone is kind of a trap, this zone is kind of a trap, don't react to it. All right, so I'm very much interested on this particular demand here. Okay, on this particular demand, so I'm very much interested on this particular demand. And then why another reason why I'm interested on on this particular demand here is because I'm using this zone here, the low of this particular zone here, as liquidity regarding to my choosing demand. All right, so that's how I now filtered. Okay, so I'm using that as liquidity. So the SMC trap, and what am I expecting or what I'm anticipating is price coming down to this my preferred demand. Though let me just put this here. All right, price coming down to this my preferred demand here, taking out this SMT trap. For me, that's an SMT trap. Taking out this SMT trap and then buy off. All right, and then buy to create a new high. Okay, so conclusion on Euro USD and forecasting for the new week. Price is selling down to a discount level, so price is still on a premium level, which is a uh good side to start looking for a sell, to sell down to a discount level in order to buy. But I'm not going to sell. I rather wait. I think maximum, not really maximum, but most of the times my trade is always 1 to 2 trade in a week. So I do wait for the higher probability setups. Okay. So I do wait for a higher probability setup. So conclusion on Euro USD, um, 1st February. My conclusion right here is, let me just put this here. Okay, this demand. Probably my stop loss should be at this swing low, and then my TP should be at this new high. Okay, so this is kind of my focus for Euro USD um, this week. Okay, price selling down to that demand and then buying from there. So you can see that's how I came up with this setup here. All right. That's how I came up with this particular setup here on Euro USD. So thank you all for joining and God bless you all. Make sure you subscribe to this channel if this is your first time reaching out, and make sure you join our Telegram channel from the link on the description, okay? So that you will know when we call out this particular trade, all right? And follow me on X at Laryforex because I will still break down even GBP USD there and GBP JPY. That will be on a written text on Telegram. So thank you all for joining.